On this edition of Elevate My Podcast, we talk to a 30-plus year veteran of the mortgage industry about a recent Biden administration change to the mortgage fee structure, otherwise known as the LLPA. The rule goes into full effect on May 1st, but we will find out why it may have already been in place. This affects pricing for conventional mortgage loans. I will link 2 articles in the description that talk more about this. The first from CBSNews.com. Mortgage fee structure for some homebuyers is changing this month. And another from FoxNews.com. Experts outraged over Biden's new mortgage rule, punishing buyers with good credit. We will cover this and more on today's edition of Elevate My Podcast. So welcome to another edition of Elevate My Podcast, where we talk about some very interesting subjects going on in real estate, mortgage world, credit, finance, really hot topics of the day and just other topics that we want to cover in related to those industries. Today, a big hot topic, something that actually dropped yesterday, was a new ruling from the FHFA. And we have a very veteran mortgage lender to talk to us about this today. Jane Gregg with Wallach and Volk Mortgage in Bryan College Station. Welcome, Jane. How are you?
I'm good, sir. How are you today?
I'm doing great. So thanks for joining us. I know we talked about this a little bit last week. I was like, hey, let's get something going on this and let's talk about this, because this is something that I think a lot of people that pay attention to these things are, definitely in on, but I don't think a lot of people totally realize this. So I think it's really good information to get out to people. So first off, just tell us a little bit about yourself and how long you've been in the business.
Long time. We don't talk about how many years, but I've been in and around the mortgage industry since about 1994. I started working for a realtor. I went to work for a title company, and then I worked with a builder, and I went on to become a mortgage loan originator after that. I do run a team in Bryan College Station called Team Gregg, when we do work for Wallach and Volk. We have all the normal loans that you would think of, FHA, USDA, conventional, and VA loans, but we also do all non-QM. Non-QM is the loans that are outside of the box, bank statement loans, ITIN number loans. Any type of loans that might not fit the normal realm in the conventional, we have that type of loan that we can do for people too.
Great. You just said ITIN. I'm like, you know what? We should do another conversation about that another time. So, because that's a question that comes up a lot, is ITIN. So we'll definitely talk about that another time. So great. Well, so Bryan College Station, obviously I spent 5 years of my life there going to Texas A&M. And it's changed a lot, since when I was there in the early 90s. And when I graduated is when you started. So I graduated in 95, but I'm class of 94. But what's going on in Bryan College Station with the market and the housing market there?
And I actually moved to College Station in 96. So it's all right there all together. It has grown exponentially, and the market in Bryan College Station is always been strong, and I think it always will be strong because of A&M. That the business with A&M bringing in more students, bringing in more professors, which people need houses. We have a lot of parents buying houses for students. They can do that FHA loan, put the student on there, put 3.5% down, run out the other 2 rooms, and they're getting their mortgage paid for them doing that way.
Wow, that's great. Now, where do you see the prices in Bryan College Station compared to other places? Like, I know Austin is almost like an outlier. North Dallas is an outlier in Texas. But I do see, like, if you compare Austin to, say, North Houston, around the Woodlands area, there's a big price difference between, say, Round Rock or Georgetown and, places like Magnolia, where you're seeing some houses that are pretty high, but you're still seeing, as I was driving by there recently, I saw some sign that said from the 250s, from the 300s. So there looks like there's still some reasonable housing in North Houston compared to like Georgetown, where you can't buy, a small shoebox for less than $500,000. So
Yeah,
what's the home prices and things like that in Bryan College Station?
you can still get a reasonably priced house at 250 in the New York market and some of the older markets too, of course. But I would see that they compare more to the Houston market than they do the Austin market.
Yeah, no, that's good. Well, it's good. I think, looking at my kids' future, I think my gosh, how the heck are they ever going to be able to afford a home when, $800,000-900,000 in some places, and you look in Austin, and it's just. Well, I was talking to a friend of mine who used to be a lender, and he was telling me about somebody who bought a home in Georgetown a few years back, and he think he paid like 700,000, and now it's appraising for 1.7.
Mhm.
That's just crazy for it to go up $1 million in 4 or 5 years.
I just
It is
listened to
insane.
Sorry, I just listened to my rate guru guy, and they were talking about how the reports came out this morning that house prices are going up. So they were touting that you could take your buyer that's buying now, and in 6 months, this is where your house is. You can do cash out refinances because your house is appraising for so much more, if that's what you
Yeah,
needed to do. Or you turn around and sell it in 2 years. Look how much you're going to buy as long as the house's prices continue to go up. But there's got to
yeah,
be a ceiling at it at some point in time.
yeah. I think in my opinion, there's another podcaster that I follow, and he talks a lot about we're hitting that ceiling, and there's a lot of different indicators to show that things, might be coming down. But in certain markets, just like we saw in 2008, when housing prices, like in Miami, crashed, for example, they didn't necessarily crash everywhere. I think in a lot of places in Texas, they stayed pretty stable. So it just kind of, I think it depends on the market. Where if we do see another housing market crash, where that will go, will it be everywhere? Will it just be certain places? So places like Austin might be affected more than places like Bryan College Station as far as home values, and but like compared to Houston. So just to be
I'll
looking
agree with
from the
that.
numbers, but yeah,
Absolutely. A few years back, I had an appraiser tell me that in Bryan College Station, everywhere else where it was depreciating, Bryan and College Station did not depreciate. We stayed the same or we got just a little bit better. If they were decreasing by 2%, we might have stayed the same or went 1% up instead of decreasing.
yeah, and that's good, and that's where you want to find, like, especially for investors. You want to find stable markets to invest in. So for
Mhm.
parents that are investing, like you said, in a home and buying a home, maybe attaching their kid to it or not, but they're buying that home and then renting it out and getting some of that money back. It's a great strategy, by the way, for parents that are trying to invest, and looking at it like, well, is it going to hold its value? And I think in places like Bryan College Station, it will, because it hasn't gotten crazy. You're not talking about, oh, hey, I bought a 1,600 square foot house, and for 300 grand, and now it's worth 7. 3 years
Yeah.
later, those kind of stupid increases that people get excited about. You're like, but it's inflationary. It's not true. Um, it's not true growth that has to do with anything. So much is inflationary. And that, well, what's going on with rates right now? I mean, everyone always kind of talks about where they're going. Maybe you don't want to, quote an exact rate, but where do you think they're going? I guess is the biggest thing. I heard this morning that, there's an 80% chance that the next meeting, there'll be another rate hike. And of course, all this is on the backs of First Republic, which is the second largest bank takeover in the history of the country. In fact, I heard this today, and I think this is crazy, that of the 3 of the 4 largest bank closures have happened here in the last 6 weeks in the history of the country. And if you take those 3, they had total assets of $500 billion, which is more than the 25 banks combined that all went out of business in the 2008 downturn. So from an actual assets perspective, what we've seen in the past 6 weeks is more than what we saw in 2008, but nobody's talking about that. So when you look at that from a rate perspective and where interest rates might go, but they're still saying they're going to increase rates even more. the Fed interest rate. But on your opinion, where do you think interest rates are going in the future?
Well, what people need to keep in mind when the Fed increases rates, those are short-term rates that get increased. So that's like if you're going to get a car loan, or if you're going to get a bank, just a regular unsecured bank loan, that type of rate is going to go up. Normally, whenever they lower the rates, and I say normally because it happened this past year, whenever they started raising rates, normally our rates go down whenever they raise the short-term rates. Okay.
No.
But last year, whenever they started hiking them, our rates went up with them because everything kind of crashed all at once. And what you said is it's hard to quote rates because rates are dependent on so much different criteria. You start with debt to income, your loan type, the borrower's credit score, even the lender fees, and of course the loan to value. Those are all factors in what determines your rates. Rates are always going to be on the move. They're going to go up and down. That is the only guarantee that you're going to get with rates. I listened to a rate guru, and he is telling us that on May 10th that we're going to start seeing rates come down. Now, I'm not saying they're going to drop 3 points in a week, but we should start seeing them. And it bases a lot on the CPI index and in the housing market. The housing market was really high in March of last year, and this year it wasn't quite as high. So that's why in April. So that's why you're going to start seeing these drops come out, because you'll see those numbers come out in May.
Oh, okay, good. That's good to know. I mean, this is why we ask the experts. There's a lot of information out there like, oh, it's horrible news, and then sometimes you got to talk to experts that know so much more of the fundamentals, like yourself, and that's good to hear that there could be, maybe we're hitting that, top end of the roller coaster, and maybe see those come down a little bit. And I think it would be a good thing for the economy in general, if we saw rates stabilize in the home industry and housing prices maybe retract a little bit to make it more affordable for homeowners across the board. Because my always biggest fear is that when homes become unaffordable, politicians start getting involved and saying, "Hey, what can we do to get more voters by doing things over here?" And we'll inject some big policy, and then they just screw things up even more. So I don't want to see that happen.
And what I try to tell my people is that to fight inflation, you have to raise rates. That's the way they fight. But they keep telling us that we're sliding into a recession, right? And what happens with recession? You have to lower rates to fight the recession. So as more we slide into the recession, you'll see the rates come down too.
Yeah, I think so as well. Well, let's talk about this ruling that's been talked about for a couple of weeks. And I don't think a lot of people really know about it, but I think for people that pay attention, they've definitely been seeing it. And, places like CNN and Fox News and places like that have picked up this and reported on it. But it just was implemented yesterday. And that's the ruling from the FHFA that kind of does some crazy things in regards to rates. And essentially it's charging high credit score buyers more to subsidize the lower credit score borrowers. Am I characterizing that correctly?
You are characterizing it correctly. And if you want to, you can pull up that chart that you and I talked about earlier, because if you look at the chart, the LLP, notice that the biggest change is in the lower right-hand corner with the lower scores and the lower down payment. I'm going to wait for you to get it up.
There we go.
And if you talk, here's the thing. The media has just come out with this. This was implemented 60 days ago, because as of May 1st, it was what loans were being purchased by Fannie and Freddie. So anything that's closed in the last 60 days, or anybody that's quoted you rates in the last 60 days, it's already got this. LPAs are already in the rates. Okay. Mm-hmm. So what it's doing, if you look in the lower right-hand corner, you can see the lower credit scores and the lower down payment is getting the biggest subsidy. The problem with that is it's kind of an olive branch that's really not going to work. Anybody with a 639 credit score or even up to 660, 679 isn't going to get approved through Fannie doing a 3% down payment, even with these subsidies that they're giving them. Then they know that. So it's not really taking from them to give, taking from the higher credit scores to give to lower credit scores, because they're not going to happen. they're going to turn around, they're going to go FHA with their loan, because FHA recently lowered their MI from 0.85 a month to 0.55 a month. So if you've got a lower credit score, and even with these subsidies, you're going to have a better rate going FHA and a better MI going this way than you are trying to go through with what they are trying to show you here with Fannie and Freddie. Does that make sense?
And Fannie and Freddie, that's what more layman people would call like the conventional loans, right?
Yes, sir, that is.
Okay, yeah. Now, what does LLPA stand for?
Loan level price adjustments. So
got it. Okay.
The next thing is you go up in the upper right hand corner. You can see that with the lower down payment and the higher credit scores, they're getting subsidized too, right?
Mm-hmm.
You see what I'm talking about? You're getting better there. What's getting hit is if you're between 80 and 85, 19.9% down payment and a 15% down payment, and you have a 720 to a 759 credit score. That's the biggest hit. So if any mortgage professional out there that's going to tell you, okay, I'm going to take you and I'm going to show you what it is with your down payment at this amount, but let's look what it is with your down payment at this amount, or look what it is with your down payment a little bit more, to kind of get around these. But like I said, the media is causing an uproar because that May 1st date was implemented 60 days ago. With every mortgage professional that I have spoken to, these were put in our rates 60 days ago. And then I also need to tell you, pricing, this is on pricing. Pricing doesn't equal rates. So say someone's looking at the 740 to 759 with a 3% down payment, and they think, oh, I'm going to get a 0.25% better in my rate. No, it's not. That's pricing of what Fannie Mae pays to the lenders when they're selling the loan to them. It may be an eighth of a point better in your rate, maybe an eighth of a point.
Yeah. So what's the biggest takeaway that people need to know about this? Are people going to sit there and say like, oh, wow, well, I need to do something to ding my credit score to get a better rate, or to get better pricing? I mean, is that what people need to think? Is that the takeaway?
It's always been that way. And they have always had if you put less of a down payment on, say, a conventional loan, you put 10% down instead of 20% down, your rate could be an eighth to a quarter point better, because you've got mortgage insurance. And that's what's backing Fannie and Freddie, saying that, okay, they've got mortgage insurance. If this buyer defaults, then I've got the mortgage insurance to fall back on. If they put 20% down, they up the rate a little bit because of the fact they don't have the mortgage insurance to back them up if the buyer defaulted.
Interesting. So in that scenario, I think I brought this up to you last week when you called. Is this like just a crazy thinking? Like, okay, so let's say I had the cash to put 20% down, but I would get better pricing if I put 10% down and took the MI, and then got the loan. And then, after making a couple payments, just made one big lump sum payment into the mortgage, and paid it down. And then went back to them and said, hey, can we do a cost adjustment based on the LTV being less than 75% and drop the MI? Would that be a better strategy?
They can, because what they do is for the first 2 years of the loan with MI, they're going to look at the original sales price. So you've got to get your loan to value lower than what the original sales price was, 80% or 78%, whenever you're doing on the back end. It's called a recast. So if you have a bunch of money just to put down later, you can come back in and do that and remove it and still have the lower rate. I don't see a lot of people doing it, but you're right. That could be done.
Yeah, because my wife and I, we did that when we bought our home, 10 years ago. We, literally, when we put our money down, and then by the time we closed, our home had already appreciated 10% over a 7-month period. And so we knew that, hey, and we did the 95.5 conventional loan on purpose. Like, okay, we know that home values are going to be going up. We can see that with the way that things were trending, and we were right. So then after, I think about a year, we were definitely below that 75% LTV without having to put any more cash in there, just based off of the home value alone. And they redid our loan and dropped the MI, after that. So, that's what made me kind of think of that strategy.
It can be done. It's called recasting.
Recasting. Okay.
Yes, sir.
No, that's good to know. Well, so at least there's, something that you can explain to, some buyers and give them a little bit of hope, like, well, what, this doesn't make any sense, but you have like, okay, here's a different option that you could,
Right.
go for. Now, what kind of long-term thing do you think this is going to be a permanent thing? It's going to be baked in for a while. Do you think it could back out? Is this something that is at the whims of an administration type thing, or what's your thoughts on that?
No, I don't see it having much of an impact since we've already had it in effect for the last 60 days. I keep telling people too, we're in short-term mortgages. And what I mean by short-term mortgages is we have higher interest rates right now. So in a year or year and a half, you see rates start to come down. You're a point lower than where you are. What's going to happen? Refinance boom. So you wait it out to that, and you're going to have these short-term mortgages, and the points are going to come down, and then you're going to have that refinance boom. And then the other thing is there's already a bill that's been introduced to get rid of these LPAs.
Interesting. Yeah. So
go ahead.
So what would that, I mean, would that get rid of this chart then that we see here?
Yes.
And there wouldn't be that 20-point, pricing adjustments?
Yep. That's exactly right. They're going to get rid of all these LLPAs. After I listened to quite a few people that have claimed they're smarter than the both of us, right? And it's possibly, they're calling this all political. The Supreme Court came out and had the CFPB and the FHFA reports at the will of the president. So it's the right right now fighting the left. And it's the right that came up and said, hey, we're going to put up a bill to try to stop this. Got it.
Interesting. Yeah, I mean, it seems like everything comes down to politics and division nowadays. So, I guess put this in that same basket.
Unfortunately.
Yeah. And that's where the thing I said earlier, when things get, crazy and hard, that's when politicians get involved and screw things up. So
true. Yeah. Very true.
Yeah.
And, it used to be the CFPB didn't report to anybody. He was basically his own entity out there. The president couldn't hire or fire him, but then they had the Supreme Court say that he answers at the will of the president now.
Yeah. Which, I mean, I could see that as a good thing. I don't know if I'd want a dictator dictating our consumer financial safeties and whatever, like, I can say this. And, I always think back, like the original, the chairman of the baseball, what he said is he wanted to be appointed for life and nobody could question him. And then he turned around and fired a bunch of baseball players, and everybody's like, what are we going to do? How are we going to do this? All the owners got together like, we got to fire him. And he's like, no. You told me I can't be fired. So I'm a czar and I can do whatever the heck I want in baseball. And that, you don't want to, I wouldn't want to have that on the consumer side, because then wherever they fall, that could be very, very bad for businesses. And they could say, well, this, and this, and then I can do whatever I want and you can't fire me. So I guess it's kind of a good thing that there's some accountability. I mean, our Constitution was built on checks and balances, right?
Right. Absolutely. That's what it's supposed to be. Yes, sir.
Well, great. No, this is awesome information. I mean, this is the kind of things that I want for this conversation, this podcast, to get out there as far as, relevant information. But I think we brought up a lot of things as far as long-term stuff. So this was really good. Well, how can people find you if they wanted to get in touch with you to learn more about what you have to offer there at Wallach and Volk?
Well, if you just Google my name, you'll find me all over the place. Or if you Google Wallach and Volk, you can find me that way too, especially in College Station. Our email is at teamgreg@wvmb.com, or it's jane.greg@wvmb.com. That's the best way. Or they can call us on our phone at 979-690-1779. Best way to get in touch with us.
Awesome. Well, great. Well, thanks, Jane. I really appreciate it, and appreciate all you do. I know we've been buddies for probably almost 15 years now, so it's been great. Yeah. All right. Well, thanks so much. Stay tuned for more podcasts as we find out more relative information. Maybe we'll even bring Jane back in and talk about the I-10 stuff and other things that are relevant to this industry.
Thank you.